This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Michael Arries, Senior Advisor at McAlvany Precious Metals, here to talk about a little bit more of an analytical approach to precious metals. We're certainly going to touch on different options for people to buy, why you might want to select something versus the other. But I really feel the benefit on having precious metal related guests on our show is to, again, talk more about than just the inherent benefit. I think people certainly understand that precious metals have value. I think that has kind of been certainly illustrated. If you've invested any money, or at least if you're maybe over the age of maybe 18, you probably kind of get that. So, Michael, thank you very much for being on with us today. Maybe give us a little bit of background about yourself and kind of how you came to be in your current position with McAlvany.
Yeah, well, thanks for having me on, Alex. I really appreciate it. It's a privilege, so glad to be here. And yeah, I've been at McAlvany Precious Metals for 14 years now, but really I've known about them since I was a kid. I've been following and investing in precious metals for going on 25 years. So I grew up in Southwest Colorado. McAlvany's located in Durango, Colorado, and have really always known about them. We saw, my parents went to some of their local conferences. We got their newsletter. So they were kind of, even before my parents, before Y2K, were even investing in precious metals. So I've known about it all my life, and really starting with some high school savings. Bought silver when it was $5 an ounce, and now it's 30. So I look back and marvel at how much silver I was able to get, even just buying a few $1,000s worth with, working at a hardware store in high school. And it's like, man, I got a lot of silver when it was $5 an ounce. I wouldn't get nearly as much today. It'd be a small pile. So I've been following these markets, analyzing just economics and world trends, and just kind of being entrenched in alternative news, alternative views of things for a long, long time, kind of bucked the trend. So, was conservative and yet did not want to vote for some of the supposedly conservative presidents we've had, and just kind of followed the alternative investing market, followed the precious metals market for a long time. I've seen the cycles they go through, seen the change in the price ratio between gold and silver. I've used strategies myself that I employ with my clients for increasing ounces. I've given myself free ounces when it's either trading from one product that has a high premium into another product and getting free ounces, or trading the price ratio between gold and silver. I've benefited from that, so I advise clients on that too. But just, followed these markets for a long, long time, and interesting to see. Always been interested to see where the world's heading, and just seeing it from a different point of view. So kind of a contrarian point of view.
No, that's fantastic. I mean, that's certainly kind of right into the ethos of what we do here on this podcast, and the broader scope of what we do as alternative asset custodians. It's inherent in the name of being alternative, and certainly the name of the show as well. So, to kind of get started with this, you kind of brought up 2 points that I think are kind of interesting to look at, of kind of examining the price ratios of these particular metals as they relate to each other, and then also about trading ounces, which I think is something I understand a little bit at a high level. I've seen some clients do it. Personally, I'll be the first one to say, I personally don't invest much in precious metals. I have, a paltry little bit that I've, picked up over the year, mainly in silver. But not to say that I don't necessarily believe in it. It's just not something that I personally do. And I always like to disclaim when I'm digging into stuff, if it's something I personally have experience in, or it's something I've just seen professionally. So I'd like to really kind of, again, dive into, what you were talking about, of examining price ratios and how that can play into some people's strategies when investing in precious metals.
Yeah, absolutely. Well, I would encourage you to get some more metals, Alex. It's there is a very good dynamic play to them. The price performance going from here, I think, is going to be very good, and we can talk about that too. But it's also something where it's not like you buy gold and bury it in the backyard and just forget about it. There is a much more dynamic play, because not only do you want gold and silver because it's real money and real savings, but since we're not on a gold standard, they're traded as commodities. Silver happens to be a much smaller market. There's a lot less value in silver out there. So it's much more volatile. It's much more easy to push around and have big moves up and big moves down. So gold will tend to be a little more slow and steady. It's funny to me when people say, oh, gold's too volatile for me. I've heard that multiple times. And it's like, really? It's slow and steady and safe and never goes away, never goes to zero. Silver, you do get a bit more volatility because it's a smaller market. And with that, we can take advantage of the change in relationship between gold and silver. So again, it's not just, oh, buy gold and sit on it and hope it goes up. It's have a precious metals position that is foundational, however much of your portfolio you want in precious metals. And there's different, feelings on that. Some people want 10%, some people want 30% because they don't trust the dollar or the government. But within that, whatever your precious metals position is, you want your mix between gold and silver to be strategic. Sometimes we have more silver and sometimes we have more gold. And the reason for that is they take turns outperforming each other. They're going to go up for the same reasons overall in the big picture trend, but they'll outpace each other at different times. When they're both going up, as they're doing now, silver will tend to outperform gold percentage-wise. It'll make a bigger move up. If they're falling, if they're correcting and going down, silver will tend to fall further. So gold is then outperforming for a time and holding up better. So we use that to our advantage to get more profit, get more growth, and trade one metal for another when we can get more ounces of one for another. These are consistent cycles. It does this historically. We look back at the charts. It consistently goes back and forth of silver and gold trading places, and there's these ranges in the relationship between the two where we know they're at a high or a low point, and so we can follow that and use that to our advantage.
Sure, absolutely. So some things I'd like to break out from that a little bit are, you mentioned that silver being a slightly smaller market. Now, I think when looking at precious metals, there's a few different ways to kind of flesh out, what exactly you mean by a market, because, the utilization, depending on your viewpoint, might be, would kind of paint the picture of that market. So with regards to silver, is when you're saying it's a smaller market, are you simply just looking at it as its relation in the investment side of like just buying, I'm using bullion as kind of a general catch-all, but, coins, everything, buying it to hold and store as a personal investment, those markets are, correlated with gold being larger and silver being smaller. But does it have anything to do with maybe the like industrial use application? Because I would imagine silver would probably be a bigger use case in that scenario. And how do those relate as it, comes into pricing?
Yeah, interesting. So when I say smaller market, I would tend to say that value-wise, there's a lot more gold out there. There's a lot more money you can put into gold. A
Gotcha.
lot less money you can put into silver. Supply and demand-wise, as far as the use for silver, yeah, there's a lot of industrial use. A lot of silver has been used up, and that factors into the silver, there being less bullion silver to invest in as far as coins and bars. So when it comes to gold, most of it is just hoarded for investment. It's not used up in industrial cases. And gold can be measured in the trillions of dollars. Most of it's held by central banks. We're never going to see that. Everything China and India buys, we're never going to see that again. But the amount of gold that's out there can be measured in trillions of dollars. The amount of investable silver that's physical, that's bullion, that we can buy bars and coins is measured in billions of dollars. It's an order of magnitude less. So that's why I say it's a smaller market. When you're throwing money in the market and buying or selling it and pushing the price around, much more volatility for silver. It takes a lot of money to move gold, and gold is moving. There's a lot of central bank money going into gold, but doesn't take nearly as much to make silver double or triple in price.
Yeah, and especially with it being, a smaller value. I mean, you don't see Berkshire Hathaway A doubling or tripling in price, but you might
No.
see that happening. Take, for example, things like GameStop and AMC that were going on the meme stock run again this week. So I think at least on a very kind of basic level, I think that's easy enough to understand just with, what you explained on, kind of call it the market cap of each one.
Yeah.
But you also kind of brought up an interesting point of, that there's a lot of this supply out there that's really probably never going to be seen by the open market. When a central bank buys something, they don't ever release. I mean, do they ever really release it back into the market? And is that something that should be of a concern for people investing? Because certainly, laws of supply and demand. If a central bank decides to offload $10 billion worth of gold bullion, that's going to drive down the cost. Conversely, if they're hoarding it and buying it, that would decrease the supply, increase, with static demand, less supply, more price. So let's kind of look at that on maybe, that specific question, but maybe in a broader sense, what's kind of driving the markets and how they operate?
Yeah, I think for the amount that's out there, supply and demand, we're not going to see a lot of it again. So with gold and silver, with gold specifically, places like China and India in the world actually account for more than half of the global demand for gold. So it doesn't matter that America is asleep at the wheel, that most people just don't realize how bad they're getting robbed through inflation and aren't buying gold and ditching the dollar. Most of the rest of the world already is doing that. So there is a huge market, a huge built-in demand for gold. And because places like China and India see it culturally as long-term family wealth, they're not going to sell it. They're not going to get rid of it when this bull market's over. They're going to keep it. So this gold is off the market. We're not going to see it again. China's central bank has been buying more than any other central bank. They're just going to hang on to it. They're probably going to partially back their currency with it at some point and just dominate the dollar as far as demand that way. But also, China probably has a lot more gold than their official reserves are admitting to. There are people that track imports going through China and the amount of mining that China does. China's the biggest gold miner. And so looking at all that stuff, there are people that estimate China has 20 tons of gold. Now, the U.S. is supposedly only has 8 tons of gold at Fort Knox, if we have it there, if we even own it. And we're supposedly the largest holder. China has between 1 and 2 tons officially. And yet there is so much gold that is moved that some people think China has 20 tons and they're just not admitting to it. Very, very likely scenario, very believable when you look at the data. So there's probably a lot of gold that we're not going to see again. With silver, so much has been consumed in industrial demand. Like when all the little bits of silver that go into computers and cell phones and smart TVs on the circuit boards or in solar panels or in cars, when all that gets put in there, that's not recoverable. That's not investable silver. It's been consumed and thrown away essentially. So the amount of silver we used to have in this country and all of those stockpiles have been deleted in electronics, and the amount that's out there now that's investable is so much less. And so when you were talking about silver being a lower price, yeah, when demand is going into gold, when the average person wants to buy precious metals and they go into silver instead of gold because it's cheaper, there's a lot more demand that can spill over into silver, and there's a lot less silver to go around. So you can see that big pop in price. You can see silver double and triple in price when gold goes up 50% because there's just way less silver to go around, and it can skyrocket the price very easily.
No, yeah, that definitely makes sense of, examining, the volatility that goes into it from having a lower supply point, and again, more consumption on a, again, gone forever kind of basis. Because in theory, a large central bank could offload it. It's sitting there. They could, if they wanted to. It's not, nothing stopping them except their own prerogative to do so. But, again, when it comes to industrial uses, it's gone with a small quotation of saying, yes, you can recover it. This stuff is recyclable, but not to a point where it's just like, hey, it's like, I have 20 tons of cell phones. Like, you have 20 tons of cell phones. You don't have, the constituent silver, how much is going to cost.
And the cost to extract that silver is, it's not doable right now. If silver were $100 an ounce, you might see more people, digging up computer motherboards from the junkyard. But at current prices, it's not economical. It's not worth it. So it is actually not recoverable. And also, I would argue too that there's probably not enough motivation for any central bank to dump a bunch of gold, unless there was a globalist Western central bank that wanted to suppress the price of gold and dumped a bunch of it. But the way they do that now is through futures contracts. They just print up fake gold and dump it on the market. They don't get rid of their real gold. But I would argue that with the current economic situation where The dollar is losing value to inflation. The Fed is not addressing that. They're just printing more money, going more into debt. The rest of the world doesn't want to buy our debt as much because they're not trusting we're going to pay it back. All these things where we're heading to currently argue that other countries are going to want to buy gold and hang on to gold and hedge their dollar reserves, and probably for a long time in the future. We're not on any track where confidence is going to be restored in America anytime soon, from the way I see it. So.
Yeah, and well, one point that I've kind of talked to, a few people about, I think one gentleman actually on this podcast as well, of looking at least, gold as being, again, a good, hedge against inflation, but also a store of, actual wealth. And when it comes to countries that could potentially or are being sanctioned on a global level, to not to pass judgment on anything that's happening, it's like say very apolitical on this podcast, but just examining, at a functional level, what's happening in Ukraine with Russia. There are massive global sanctions from almost every single major global player, minus China maybe going into that. But the need for an economy to continue on, it doesn't matter if you're in a conflict. We were in global conflicts for almost 20 straight years, and we still had an economy to run. You still got to go buy bread. You still got to get oil in. So, one thought was that maybe with a potential increase in global conflict, you might see some of these stores of gold coming back onto the market to help to finance economies and other, governmental functions of some of these, larger players. Do you see that as being something that might occur if, things don't necessarily change with some of those sanctions and conflicts that might be going on?
Maybe. Interesting thought. I'll try to stay as apolitical as possible, but I'll have a hard time doing that. Just kidding.
Yeah.
As far as what you mentioned with the sanctions with Russia, that was a big deal. That plays into this with, the Fed creating inflation, the world not trusting our debt. The Russia thing is another puzzle piece to that, because yeah, we sanctioned them. They couldn't use their dollar reserves. Having gold as a backup, trading with different partners kind of gets around that. But the rest of the world is going to look and say, oh, well, what if the U.S. decided to, freeze our dollar reserves that they have? So that's a game changer. That's something where a lot of confidence was lost. We're kind of entering a new paradigm that we weren't in before, as far as the dollar being the dominant reserve currency. So it is a big deal, and that is something where I think countries will want to have gold, and a lot of countries have been repatriating their gold. They've been taking it back from New York and London. They want to hold it themselves and want to have something that is real money if they don't trust the dollar or the dollar system, based on, us sort of breaking faith in a sense with the country, being able to use that.
No, and that definitely makes sense, at least in the short term. In the short term, this kind of instability would probably spurn more purchasing on the central bank. It's like, hey, we need to hedge, and again, in the short term, and again, you see this kind of where it goes with fiat currencies, if you will. A depression in value of things when it happens, when there's global conflict. You're like, oh, let's, like things are going to get more expensive, X, Y, and Z. This is losing value, but the consumption, at least on a very high level, call it the again the central bank level, would wager to guess that it maybe would, in the short or the near short term, because nothing ever happens fast when it comes to global conflict, increase the demand and therefore, spike that price. And I'm sure there's a million different things that go into, between economic global uncertainty that kind of spurns the demand for gold. But to transition a little bit away from that, I think the point has been made to kind of come back to strategizing with that. The first thing that you mentioned, which I found very interesting, was having a strategy that can be based, again, we don't give financial advice, and the certain strategies anyone should use for making an investment decision needs to be born directly from them and their advisors. But at least on a high level, looking at it from the perspective to kind of base my question on, is saying most people, and myself included, probably think of buying one, waiting for appreciation, and then selling. Warren Buffett said, gold is great, but it doesn't pay a dividend. So most people are buying, kind of for that strategic, hedge against inflation. It makes them feel good. It's always going to have value. It's never going to go to zero. But on kind of the more active side of things is something I really haven't examined with people. So when you're talking about, examining price ratios and moving into one for maybe acquiring just a more sizable position, not just dollar value, but just in, physical footprint. It's like, hey, I have 2 ounces of gold. Let's get, 50 ounces of silver. Now my 50 ounces of silver, maybe, in trading, what are some of those strategies that, you employ or that you look at when it comes to maybe doing those repositioning strategies between those two?
Yeah, no, I appreciate the question again, and going back to this topic, because that's what we offer our clients is a tailored strategy on how to make the most of owning precious metals, not just sitting on your gold. But if we look at that historic cycle, the back and forth relationship between silver outperforming, then gold outperforming, then silver outperforming, if we see where we are at in the cycle, we want to be heavier one metal or another. So we might be heavier gold at one time, we might be heavier silver. So if you have a precious metals foundation, you're like, I want to put 10% of my wealth into precious metals, we might say put 2/3 into gold and 1/3 into silver, or we might say put 2/3 into silver, 1/3 into gold. And if we're on the right side of that and we have more of the metal that's about to outperform, well, then we'll shift that allocation at a certain point and trade one for the other. So just what you're talking about, like right now, the ratio between gold and silver is 80-1. It takes 80 ounces of silver to buy an ounce of gold. Now, in 2011, at the last price high we had before this breakout, that ratio got down to 30-1. So you can imagine, being at a time like now, well, rather than buying an ounce of gold, let's buy 80 ounces of silver. Because when it gets down to 30-1 again, well, then we trade our silver for 2 ounces of gold. And instead of having one that we originally bought and sat on, well, now we have 2 ounces of gold. We've doubled our ounces. And then as it goes back the other way, because it flip-flops back and forth, well, then we take one of our ounces of gold and go back into silver, and now we've got an ounce of gold and the silver we originally had. So it's a matter of following that trend back and forth. It tends to cycle every few years, and there's certain inflection points, certain trigger points that we follow. So if we can start out on the right side of the ratio between gold and silver and have somewhere to go, well, then we reach out and let our clients know, hey, we're at this point. Hey, look, you're getting this many more free ounces of gold than you could have started with. Let's shift. Let's move some of your silver to gold or your gold to silver, and we let them know when to do that. So it's we've had good back and forth moves a few times in the last 20 years. We've had some good multiplication in ounces. I've done it myself. I've seen it happen. Or when we have premiums on products, if we have silver eagles or 90% bags of junk silver have a 30 or 50% premium, well, we've seen that happen because of different factors in the market for a brief time. Well, then we'll have our clients that have those trade it for, bars or something that has a low premium, and I did this myself. A couple of years ago, we had a high premium on silver eagles that the market was paying. So I traded in all of mine and just went to silver bars, and I got 400 free ounces of silver. For the amount I traded, I ended up with 400 more ounces of silver. Now imagine that, 400 ounces of silver that I never paid for. I got totally free, never spent any money out of pocket for. That's what we do with our clients, and there are lots of opportunities to do that where you gain free ounces, whether it's a product premium or trading the price ratio. So we got to set up on the right side of things initially, and then as those shifts happen and as there's a good arbitrage trade, then we let our clients know and do that. So your precious metals foundation, your pile that you have, gets bigger and bigger over time without you adding more money. And it's just those marketplaces. Other people do that. There's arbitrage trades where you buy one currency and loan it out in another currency and make the difference. Well, we're doing that with your gold and silver. You just normally don't think of doing that with a tangible asset like that.
No, absolutely. And you mentioned a few things in there that I really kind of want to dig into. And it really kind of expounds on some of the other content we've had with precious metals. But it kind of boils down into kind of choosing, which product to buy. Because, silver at the end of the day at a, functional level is silver. If it's a certain purity, it doesn't matter if it has, a panda or an eagle or a maple leaf stamped on it. It is, silver. It is the content of it. It's what it is. But what you mentioned is that there was a large market premium being paid between your, again, I can't remember the U.S., the silver that you had versus bars or bullion bars. So what kind of would drive, again, a market to say, hey, this piece of silver, is worth inherently more than this one? What would drive like a product differential like that to create that arbitrage event?
Yeah, so normally it would be a collectible coin, something that's old and rare and they don't make anymore. And if there's a market demand for that or collectors desire that, it can have a higher premium than just a common silver coin. So collectible coin can be one way to do that. I've had an arbitrage trade with silver dollars, old silver dollars, where in 2010 they were dirt cheap, and then by 2013 or 14, they had like a 60% premium on them. So we were able to have a little arbitrage trade there and just go into silver rounds and get free ounces. But there's other products too that normally would be considered bullion. So what we call junk silver or 90% silver, that's the old dimes and quarters and half dollars that are pre-1964. So when you buy the old currency coins that are 1964 and earlier, they were made of 90% silver. So they don't make that anymore. It's limited in supply. We know from insider info that a lot of those bags have been melted down and sent to industrial use. So there's very little of that around. A lot of people still like it because it's U.S. Mint silver coins. They like that it's something recognizable and known. So when there's a high demand for silver in general, and we've seen a lot of that since COVID, the premium on the 90% silver coins, the bags of those coins will go up because people want it. People want silver. You can't just go and mint more of those. They'll go make more rounds and more 100-ounce bars, and we just have a supply delay, and we just have to wait for them to make more, but then we get more. But with the junk silver, they can't make anymore. So when there's a demand for it, premium goes up. You got to pay more. You got to pay as much as 20, 30% more for those coins. So that's one where we've seen, 3 times in this bull market in the last 20 years, a pretty good premium on junk silver coins. A couple years ago, I want to say 2015, and then around the 2008 timeframe. So that's one where when it's cheap, and it's actually cheap right now, it's not much more than a silver round, buy it. And then if we hit one of these points where demand drives the premium up, great. Then trade it for bars or rounds and capture that 20 or 30% in free ounces.
No, absolutely. And one, just a quick aside,
Mhm.
most people know that have been listening to us for any appreciable amount of time that we do this podcast as an adjunct to what we do professionally as IRA custodians. The specific strategy that Michael was talking about right there wouldn't necessarily be something with the products he was talking about be utilized in an IRA. You do have certain purity standards that you need to use
Yes.
for an IRA. But again, great information as far as, and again, we like to cast a broad net, not just for doing this with an IRA, but personally, certainly a usable strategy. But again, since we are, my day job, the Advanta IRA, I just want to make sure kind of if we get into something that doesn't work for an IRA, that's maybe a better thing to look at for your personal use, just to delineate that. But again, that's
Yeah,
a really
Alex, can I jump in on that? This is actually a great strategy for an IRA, so I would want you and your clients to know that. So with something like junk silver, that doesn't go in an IRA, but with the ratio trading strategy between gold and silver,
Mhm.
that does work in an IRA, and that's great. So yeah, there's certain parts of it that wouldn't work in an IRA, but overall, our overall strategy is actually really great in an IRA where you don't have capital gains tax, where you have it easy to transfer because it's in storage. So we will definitely look at that with clients. If it's something at home, they want coins, they want junk silver, and there's a product premium trade, that's one thing. But
Mhm.
inside an IRA, if someone does a precious metals IRA, we're going to set up for that ratio trade, whether we're heavier gold or silver, and huge advantage, huge tax advantage, huge logistics advantage to do that in something like an Advanta IRA or whatever. And yeah,
Yeah.
great vehicle for it.
Yeah, and again, I was just specifically referring
Mm,
to the unit that was being traded
mm,
there, but certainly the strategy, absolutely, you could
mm.
definitely do that within an IRA.
Right. Yeah,
Um,
the junk silver doesn't work, but a lot of other products, or when we had a high premium on silver eagles, that worked in an IRA. So yeah, so there's a good place for that.
yeah, absolutely. So again, that's a very interesting
Mm,
strategy, not something that I would have ever kind of thought really would even have created that much of kind of a price differential or an arbitrage event. I guess when I like to always learn something in this podcast. When my preconceived notion about precious metals
mm,
again was more of the
mm,
Warren Buffett side. Hey, it's
mm.
great. It serves a
Yep.
purpose. It is not going to go to zero.
Mm,
Just like why I like real estate. Even if an act of God happens, you still own the dirt. There's still tangible value to what you have, unless
mm.
it goes underwater, which where I live in Florida might be a concern.
Yep.
It's the beach is about 2 miles that way, but again, to illustrate the point of again
Mm,
something that is going to maintain intrinsic value come insert what you want or high water, is certainly something to appreciate in these types of assets. Now, the other part, and I'd written one down and kind of bumped the premiums. So I thought that was really interesting. But you mentioned kind of examining market inflection points when you might want to look at one versus the other. And I think again the high level of saying, yeah, we see a premium or a driver here. Okay, let's do that swap trade. But on a broader context, what are some of the inflection points that you look for, and what are some things out there that kind of drive these inflection points that you've seen historically?
I think it's just the price movement and just being in a bull market. So, it kind of leads into what's happening now. We've had a price breakout. I think gold and silver are going to go up quite a ways, and that's going to be part of that. Is we're in an uptrend, silver's going to outperform, and when it does that to enough of an extent, then we can trade one for the other. So, that strategy will come into play as this market continues, and that's just being driven by inflation. The central bank has printed too much money. Gold and silver tend to account for all the extra dollars out there, all the extra currency out there over time. They tend to go up as there's more money out there, and we're at a point where they're nowhere close. If gold and silver do what they did in the 1970s, in today's dollars, we'd have $10,000 gold and $500 silver. So crazy to think about. Those seem like crazy numbers if gold and silver go up 5 to 10 times, but that's actually just the basic math. And that would be them repeating what they've done historically in the past in today's dollars. So big move left to make. And as that happens, as they're going up, then we see, gold and silver outpace each other at different points and take advantage of that strategy. And the time is now. I mean, they've broken out on the price charts. Gold is broken out to all new highs. 2,100 on gold was kind of a ceiling that once it went through that, we're like, all right, we'll probably be starting a big new trend. And it blew through it and never looked back. Like huge move. I thought for sure we'd have a lot more resistance around 2,100, kind of testing that price level, and it just took off. So now the sky's the limit on how far it can go, depending on how much confidence is lost in our system, and then silver still needs to get to 50 and beyond to set a new high like gold has. So that'll be part of it outperforming. From here, it's got a big jump and a big catch-up move to make to where it'll increase faster than gold will, and then set a new high. And then we'll see how far they go after that. But we're on this trend. They've basically left the starting gate. The race has started. They're on the way. There's still quite a few laps. We haven't missed the boat, but it's coming. We're not waiting years. We're going to see this play out over months and the next year or two to see them make a big price move like that.
No, that's definitely a good point of looking at where the price point is in relation to what its historical high is, because things new records are set every day, but typically the next person in the race doesn't break the record of the person in front of them every single time it goes out. So there is going to be, if nothing more than just a psychological aspect to the market where people, eventually will get spooked and saying, hey, this stuff is constantly trading, it's time to pull back. And that, again, the psychological aspect, I think in any type of market, always will play out. And it'll be kind of the first domino to fall of people saying, okay, great. I love making money at the top, but if you look at any mountain, it has another side to it. So, when looking at the market like that, there's kind of two things that I wanted to examine from there. First being we talk about everything that makes these things go up, which is awesome. You always want to, be looking at what goes up, but the converse to that, which you always need to be aware of, is what's going to drive these prices down. Because it's always going to say, hey, this is going to make money, this is going to appreciate, but you need to be equally aware of the factors out there that are going to kind of suppress things or cause one to pull back in relation to another, or cause everything to pull back. So maybe if we could examine a little bit of things that historically, or you think maybe in the future, are going to cause a retraction or a pullback in the market, and some things to look out for in that regard.
Yeah, good question, Alex. And I think that is something in the future. I think we're on a trend here where they're going to go up quite a ways. And there will be indicators when we're near the end of this bull market. And when we do want to start reducing our exposure to gold and silver, take those profits, take those gains off the table and put them into something else undervalued, and reduce our exposure to precious metals. So there'll be things, but that is probably in the future. That could be 5 to 10 years away before we see the metals peak out and want to start doing that. But I mean, it would have to be the central bank not printing money like crazy, the government not going into debt like crazy, there being peace and not wars around the world, everyone getting along and feeling good and feeling like there's, good prospects on the horizon. So, pretty major shift from where we're at. I think we do need to go through kind of a mess, kind of have the consequences play out of what our central bank has done. Too much debt, interest rates too low for too long, printing too much money to prop things up. We're going to have to go through the consequences of that. So there's probably going to be a number of years where we do want to buy and own gold, and it's not going to make sense to sell it. But eventually, we'll take those gains off the table. If we see the Dow to gold ratio get down low enough, that indicates, oh, gold's too high, let's sell it. If we see things change in the world, if we see certain shifts in people's behavior in the world, we can start to say, okay, we're near the end of this gold bull market. Let's start reducing our exposure. So the time will come. I think we're a ways away from that, and I think we'd have to see a completely different world than what we're heading into to say, okay, now we're done. Everything's getting better. But I don't see anything getting better. Our political dysfunction is off the charts. There's no way anyone is going to fix anything. We're
I
I
think
won't
we
get
can
poli-
all
I won't
political.
I
I
won't
think we can leave that one there. Political
I won't
dysfunction. Yes.
I won't get political. So all that to say, I'm not going to sell my gold in the next year or two, not by any stretch.
Fantastic. And again, I mean, I think what you illustrated is
Mhm.
easy enough to understand, but it's as something as simple as world peace.
Mhm.
That's all we need, right?
Yeah.
Um, so it's what I like about precious metals,
Mhm.
and another thing, what I like about things like real estate as well is another big thing I very much believe in,
Mhm.
is the inherent simplicity of it. That you can make things very complicated, but at the end of the day, the attractiveness of the value, the attractiveness of the appreciation, and the facilitation of
Mhm.
trade within those markets is something
Mhm.
that everyone can kind of grasp. You don't need, an economics degree from Harvard to kind of
Mhm.
understand why this happens.
Mhm.
As opposed to getting into the markets and leading into my next question of, extremely complicated products that are on the traded markets, the commodity exchanges. You do need an economics degree to kind of understand some of those things.
Yep.
I like to think of myself as a relatively educated person on the aspect of I've been doing and operating in finance for quite a while,
Mhm.
and I still scratch my head anytime I talk to someone that sits on a trading desk. I'm
Mhm.
just like, what? Like, are you actually speaking English?
Yeah.
Like, this makes no sense to me, in many
Yeah.
different aspects. But what the question that I'm leading into is, and we kind of alluded to it in the beginning of it, there's a big difference in investing in precious metals in two different categories. One is buying the physical precious metals.
Mhm.
Whatever that looks like to you, you have something that you can pick up, hold, melt with a
Mhm.
blowtorch. You have it in your hand. And the
Yep.
other aspect of this is again, kind of the unquantifiable, the paper aspect of it. And what
Mhm.
I'm curious to know is that what kind of relationship do you see between like those two markets?
Mhm.
Is it a direct correlation? How much velocity is caused for price point differentiation between what goes on in the paper markets and what goes on in the physical markets?
Hmm. Yeah, good question. I think with the paper markets, it depends on what you're looking at. If there's mining shares, if you're buying stock in a company that mines gold and silver, those can do very well at certain times when gold and silver are going up, the price is going up, and those companies become exponentially more profitable. Their costs are fixed, they're already mining at a certain level, and gold goes up. Let's say gold doubles in price. Well, great, they become extremely more profitable, and their share will go up a greater degree percentage wise than what gold goes up. So there can be things like that. An ETF can track the price of gold 1 to 1, or you can have a leveraged ETF that tracks it 2 to 1 or something like that. And they've got complicated mechanisms behind it to do that, which are hard to understand. But
Yeah,
but again, you're speculating on price at that point, whether a mining share or an ETF. You're speculating on price. You are betting on the market. You're hoping you're on the right direction, and you're taking your fiat currency and putting it in the market and hoping you get more of that fiat currency back. I think the difference with physical metal is that gold is real money. It's the best form of money that's out there. It's got intrinsic value in and of itself, and there's no counterparty risk. That's also the big thing with any kind of paper asset. There is someone else that has to keep their promise and do their job right in order for you to get that value back. With gold, nobody's involved. Physical gold. If you have a physical gold coin in your hand or a gold bar in your IRA, no one has to do anything to make that have value. It has intrinsic value for being a rare, limited in supply ounce of gold that is hard to mine out of the ground. It takes a lot of energy and cost to do that. That's all built into that. So, for having precious metals as money, as insurance, as an inflation hedge, owning it physically is the best way to do it. That's your gold. No one else has a claim on it. No one else has to make it have value. If you have a mining share, hopefully you have the right one, or maybe you buy an index, but you could buy a mining company where, let's say some country overseas takes their mine back and says, sorry, you can't have this anymore. And then that share, drops by 80%. That can happen. With gold, that's not going to happen. You're not going to see gold drop by 80%. Not with what's going on in the world, not with the amount of money we've printed. So it's something where it's got the value in and of itself. It's like having cash. It's simple, like you were saying. It's simple. You don't need an economics degree. It's just like having cash in your wallet. It's just gold and silver is a better form of cash. It's not a piece of paper that the government says you have to take. Gold is money everywhere in the world, all throughout history, no matter what anyone has said.
Yeah, and I think you brought up a good point too of examining kind of the paper aspect when it comes to mining companies. And I had a very interesting guest from a company called Dakota Gold Group who was seeing an opportunity to repurpose U.S. mines in North Dakota. It was North or South Dakota? Called Dakota.
Yeah.
But the aspect of why they made that play was one, the need for precious metals as illustrated strategically by what happened with COVID and what's happening globally right now. And also the ability to, wholly own that asset in a government, in a country that's favorable to that. When you look at the broader scope of, mining operations, you have places like China, Russia, Indonesia, well, maybe not Indonesia, but countries that will more often than not, when they have a more, and again, not saying this anything further, just a factual statement, a more a governmental, a state government that requires that they have a vested interest in whatever's going on. Typically, in some of those countries, they'll require that a government-controlled entity will own 49% or 51% of that operation, and to have something like that repatriated if something happens in the global, the global arena is a real risk. So, investing in that output source can definitely come with its own problematic issues, especially if in the United States and there's tension between those two and it's a U.S.-based company. Again, that certainly is a risk concern to look at there. But that was kind of an interesting factor that I thought about, was that there's movement from things like, that happened with COVID and supply chain interruption that is driving more interest in this whole economy. Again, you have to pull it out of the ground to have someone actually want to buy it, which I thought was pretty interesting. Are you seeing any kind of additional movements like that where people are trying to pull back from countries that maybe have that kind of, forced ownership cooperation to more friendly countries where maybe they had pulled back from mining operations?
Yeah, I mean, as far as what we do in the physical precious metal space, a lot of it just has to do with people wanting to buy and own gold and have that protect their wealth. Now, as far as where they keep it, some people keep it at home. A lot of people keep it in an IRA, like an Advanta IRA, but some folks will store it overseas, or maybe previously have stored it overseas, like Canada or London or Switzerland. And we're seeing people now that say, oh gosh, I don't trust Canada. I don't trust Trudeau. He tried to take, the truckers' bank accounts when they were protesting. So yeah, can't trust them. So, let me take my gold back. I don't want it stored overseas. There's maybe
For sure.
10 years ago, they didn't trust the US government and they put it somewhere else. Now they're like, oh, I don't trust Canada. Maybe I should take it back here.
For
So
sure.
yeah, I mean, I think overall with what you're talking about and your example, there is a lack of trust just around the world, and everyone's going to grab what's theirs or what they think should be theirs and make sure they hold on to it, because it's not an era we're heading into of just comfort and peace and, oh yeah, no one's going to mess with me or take my stuff. Now everyone's like, let me grab whatever I think is mine or should be mine or whatever I can get a hold of and hang on to it because I don't trust anyone in the world. So yeah,
For sure.
interesting times. And then with physical metals, that's your insurance policy. That's real money. So if you have it, you own it, it's in a safe place, that's something that's always going to give you value.
And to kind of one of my last questions, and I kind of thought this up. I was debating asking it or not because it is a little bit out of left field. But in the examination of kind of why we've talked about precious metals of being valuable, right? They are a mechanism of trade. They have value. You don't have to rely on that counterparty, right? It has value. You don't have to rely on the U.S. government or China, Australia, Canada, whichever one backs that dollar to do something. And again, I think we're really very early in cryptocurrency's life cycle to say what effect it might have. But, it does bring that kind of that thought process into another asset class of saying, we the people define this value, and it's not beholden to governments. It's out there. It's, it's currency for the people by the people. Have you seen, maybe you haven't even, tracked this, but do you see that those two, between cryptocurrencies and precious metals having any type of effect on each other, of the utilization and adoption as we go forward with, again, a lot of uncertainty in the world? Do you see that happening, or have you seen that happen at all?
Interesting. As far as them, playing against each other or doing the same thing. I'm not against, being a gold and silver person. I'm not against crypto. I just think they're different things with different
Sure.
different uses. So when it comes to someone saying, oh, Bitcoin's digital gold, we don't need gold anymore, I'd say, well, no, gold is gold. Bitcoin can't replace that. It does something different. It's an alternative currency. It's a decentralized currency. You can use it for moving money electronically. You can use it for different things. Gold is still gold. It's still a tangible form of money that is going to operate no matter what happens to our system, the electrical grid, whatever. It still always has value.
Yeah,
But
you
as
don't need
far
to
as
have a server to,
yeah,
to
yeah, it's like gold's always gold and always there. But
yeah.
interesting to see them both going up. They're both at all-time highs right now, and I think it just reflects a lack of trust in the government and in our system. There maybe was a time, 5 years ago, where it seemed like money was going out of gold and into Bitcoin, because it's like, oh yeah, why would we have gold? Let's have Bitcoin, and now that's sort of faded. Bitcoin had a big 60% crash. Now it's recovered from that, but that volatility is there, and I think there's more of a concept now that it's money, it's a currency, an alternative, decentralized digital currency that's outside the government's control, more or less. And if you know how to use it, if you store it yourself, not with some online server where the government might subpoena them, if you know how to use it, it's a good alternative asset to own. And gold is, I think, a complementary alternative asset to own, where it has different advantages, different benefits than what cryptocurrencies have. So I'd say have them both. And I see people going into both as just, part of that overall distrust in the government and the dollar. That's why they're both at all-time highs. They just have different uses.
Yeah, I would really be interested to start tracking the relationship between, price point and velocity of something like Bitcoin to gold, and then picking on Ethereum being the silver of the cryptocurrency markets, and just kind of tracking it and see where it goes. Again, it's so early in the adoption and its life cycle that to make any type of informed correlation analysis, again, is very early. We really haven't seen markets come full circle with that, like we had with precious metals. You can look back to the Romans and before to see, price inflections and where the markets go. And again, it's very premature to look at that, but it just, when you mention something, like the utility of it, and being decentralized, it's, there are correlations to be made. And to your point about you don't need electricity, a small anecdote to kind of end things off. We had, those huge solar storms that came through, and at least here in Tampa, of course, right when that happened, we also had it was literally someone they think had backed in with a small Bobcat front end loader into a fiber junction box.
Ooh.
The internet from Bradenton, or Sarasota, which is about 2 hours south of where I live, about an hour north, and all of Tampa, our main ISP went down.
Wow.
Completely. And then the cell networks were bogged down. I had to go get gas, and the guy was like, can't do it. I mean, I had cash, and
no
no
credit card machines.
Yeah, the guy was really nice. He's like, yeah, cool. I'll turn the pump on, gave me the receipt, came back with cash and settled up. I mean, granted, I go in there every day to buy a Diet Coke, so he knows me.
Yeah.
It was a little dystopian there. We didn't have internet for almost 24 hours. Granted, it would have been hard to shave off a piece of a gold coin. We didn't have a scale, to do that with. But again, it's just kind of an interesting illustration of, the need, we have a fragile, ecosystem to a point, where the sun can spit out a big glob of plasma and wreaks havoc on us. So, something that can guard against that is good. And to kind of end things off, I always like to make sure our guests can, give out their contact information. If you have anything going on or people want to get in touch with you, certainly, you do work for a precious metal broker. So if people are interested in learning more, potentially acquiring some things or engaging with you, how can they get in touch?
Yeah, probably the easiest way, Alex, is just to call or text me. I can give you my phone number. You can put that on the show notes. It's 970-459-4611. Again, 970-459-4611. Just call, shoot me a text, and I'll usually get in touch the same day and answer any questions.
Fantastic, Michael. I really appreciate you being on with us today. The one asset and the one thing we can make no more of, no matter how hard we try, is our time. So I appreciate you taking some of your valuable time to spend with us today. Again, my name is Alex Perny. This has been the Alternative Investing Advantage podcast. Hope you got something good out of today's show, and we'll see you on the next one.
Thank you so much.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.